today's topic, I think on my end, I want to talk about supply chains and inflation. Something we're hearing about in the news and something that's affecting, in a way, the markets. And there's a lot of fear from inflation. I think, as opposed to different times in history, in the last 20 years, I think this time we ought to be more careful about inflation and the effects that it will have on everything we do. I come from where I grew up in a country that the average inflation rate was between 5 and 10%. It creates issues in business that in other places, I think in the US, that people in the US they're not accustomed to.
I'm going to talk about a specific security. And before I even say anything about that, this is not advice about the security. It's not a recommendation. But I'm going to talk about ticker GBTC, which is the Grayscale Bitcoin Trust, which is a enormous, controversial tracking security for Bitcoin. It's got some interesting stuff going on, so we'll go through it.
So first of all, supply chains. We heard what happened last week with that giant boat that got stuck in the Suez Canal. It created a bottleneck of boats going to Europe. Mostly of them it's traffic going from Asia to Europe. They saved themselves, I think, like 12 days of fuel and time going through the Suez Canal. And having that boat blocked probably is making that some of the supply chains are going to be further constrained. Obviously, these things can catch up pretty quickly, and so the total delay will probably be like 2 weeks. It's not terrible. The issue now that you're seeing in some places is that the problem is that when a bunch of boats come into port, there's going to be bottlenecks at the port as well. So the ports are going to have to work overtime, creates additional costs, and then the rail is going to have to work overtime. So this entire bottleneck just continues and continues until you reach destination. And once you reach destination, probably at that point, things will have to accelerate again, and then that gets resolved. All along the entire process, additional costs. And these costs, somebody's going to have to bear them. And this is the issue, that we're going to start to see, I think, inflationary pressures. And it's not the traditional inflationary pressures where you say like, oh, the economy is overheating and the employees are demanding more money to work for you. And as a result, like, it's going to cost me more. Because we always had a solution for that. And it was, China. China was the biggest disinflationary force in the world. The more things got more expensive here, we shipped, costs or production over to China, and China solved that issue. The problem is that if you ask, factories in China what the biggest problem is right now, it's recruiting people to work at those factories. Those people at those factories are demanding more and more money, and it's not small quantities of money. They're demanding raises that are substantially larger than, I would say, what we're accustomed to here. Normally, factories in China would see about, I would say 5 to 10% increases in wages every now and then. But now you're talking about numbers are much bigger and they're more frequent. On top of that, you have this issue that normally in Asia in general, if things got too expensive in China, you would move on to secondary countries like Burma or Myanmar. But now that country is kind of has their own issues. Bangladesh, there's been years where clothing factories, which is like the first factory that moves, is like garments. They move to the cheapest labor. They have been moving around, and you get to a point where you can't move too much around anymore. I mean, the next place will probably be, I would say, someplace either in the Indian subcontinent, maybe in India, or even in some places in Africa. The problem is you need infrastructure, and there is not a lot of infrastructure in those frontier markets. China still has the best infrastructure. In any case, inflation will be around here, and I think it will mean that prices will go up. Supply chains put further pressure on prices because shortages is actually one of the biggest inflationary pressures out there. In the 1970s in the U.S., whenever there was that burst of inflation before Volcker came in and raised interest rates, the real reason why there was a lot of inflation was supply chains. Oil, it started with oil, it continued with other, I would say, commodities, but it was supply chains that actually drove that forward.
Inflation is coming. It sounds like you're an inflation bull.
I'm an inflation bull, and my key concern that I have here is that yes, we'll see interest rates going higher. I don't think the Fed right now is particularly concerned about that. They don't really care so much about the inflation as much as getting back to full employment in the US, and they want the economy to recover. To me, also, there has been two issues that has been driving this supply chain mess. One is the demand. We have way more demand for home stuff like furniture and stuff like that. Since we're not spending our money in restaurants, travel, and entertainment, we've decided to spend it on upgrading our house and making sure things are nicer. And that's just created a huge pressure because that's actually the stuff that gets transported across seas. But I think once we open up the economy, we'll see a diminished demand in those areas, and as a result, I think we're going to see less inflation pressures in those things. But remains to be seen. That's just a theory.
I'm a part of a book club, Gabe. I don't know if I've told you this. Shout out book club.
That's very intellectual of you.
I know. We just finished a book called The Outlaw Ocean or Outlaw Oceans by Ian Urbina. Highly recommended to anyone. A really cool collection of stories and reporting from around the oceans. A lot about wildlife, a lot about life on the oceans, human impact, et cetera, et cetera. I want to ask you specifically from the beginning of this, we talked about the block in the Suez. Let's connect the dots between inflation and maybe shipping companies. Have you ever done analysis on shipping companies? Have you looked at them? I know a lot of value dorks who like to buy very cheap stocks end up looking at shipping because shipping trades at very low multiples because it is a dirty, grimy, capital-intensive, difficult business with exogenous issues like someone blocking the Suez Canal on accident. Possible? What do you think about inflation and shipping in general?
So shipping is a tough business. I would say I have not looked at shipping recently. The last time I looked at it was when oil companies the oil price was negative because it would mean that it was more efficient to store oil on ships and wait until the oil price came back. And so you were renting out space in the oil container ships until the price resumed its positive territory. In general, shipping, I don't think has been a very positive return industry to be in. I'd say just has short bursts of overperformance, and that's what brings in a lot of investment.
Do you think inflation is good for shipping, logistics, kind of moving the business of moving physical goods around the globe?
I think so, because if you think about this, right? Every business wants to make more money. I think at the end of the day, these shipping people already have a lot of container ships. Will welcome a little bit of inflation, and the reason is because they can charge more money and their capital costs have already been allocated, right? So if suddenly you're making 30% more in 1 year, but you already paid, the cost of your boats. Then you're just making more money from the capital outlays that you've had. For those people who want to make new ships, I think inflation is not really the best deal for them. Inflation is usually, it promotes spending quickly, right? If tomorrow the price of bread will increase, then you'll buy it today. The only thing I'm saying here with inflation, if you're like an individual, first of all, always consult with your financial advisor or tax advisor or whatever advisors you have.
You ready to move on to my weird little corner of the market topic today?
Yes. Tell us, what is GBTC?
Yeah, so you told me before the show you've really never heard of this, Grayscale Bitcoin Trust or GBTC?
I've heard of actually the Grayscale Bitcoin Trust. It was the only quick way of investing in Bitcoins if you didn't have a wallet.
That's right. So this product has been around since We could look that up. I think 2015 or 2016, like quite a long time. And it was the first product where you could access Bitcoin from your regular brokerage account at Fidelity, at Schwab, at Interactive Brokers, wherever you were. So that was a really big deal back in the day. And they've raised a ton of money into this product.
The market cap is, or the total assets under management is 37.31 billion.
All right, $37 billion into a fund that puts it among probably top 25 ETFs in the world, maybe something like that. Maybe top 100 ETFs in the world. It's
top 100 for sure.
It's an enormous product with a lot of daily trading volume, and it's absolutely a market mover for Bitcoin. There's been a trade because of the nature of the product. It doesn't arbitrage well like an ETF does. So ETFs as a structure do a pretty good job of trading close to their net asset value. That's just a structural piece. That's not always the case. ETFs can definitely trade.
The net asset value is the value inside of the fund, right?
That's right. The value of the underlying assets, which is not always so easy to find, right? Think about thinly traded municipal bond markets, for example, right? There's not always a clear, constant price for every asset in there. So there's some latency in the calculations there. But anyway, ETFs have been proven, battle tested, staying close to their net asset value, meaning if you go to your brokerage account and you buy it, you're going to get roughly the amount of value that's inside the fund when you go and buy it. Since inception, the premium to NAV has been as high as something like 60 or 70%, meaning that if you bought it at that peak, you're paying 60% more in cost than the value that you're receiving in the underlying Bitcoin in the fund, which is really preposterous when you think about it. Paying $1.60 for a dollar. I
don't understand. Why wouldn't you invest in Bitcoin then?
Many people chose to do this instead. Looked at the premium. Maybe they didn't look at the premium, but it's a new and strange market. I'm not really sure why it got so high, but I think that the story of it going down. So if you look at the chart of the NAV, we can pull this up on Y charts. From December 21st of 2020 until today, it's almost a straight line down of the premium. So the premium has really collapsed. On December 21st of 2020, the premium was 40% above the net asset value. From then to now, we are now in February. We saw the first discount to NAV in this product. Wow. It looks like late February. It traded just under NAV at negative 3%, and today we sit at something like negative 8% to NAV. And there's a bunch of stories behind this, and a bunch of moving parts. I think the big ones are that there was for a long time a considerable hedge fund trade where these hedge funds did what's called the private placement with GBTC, where you could go straight to the sponsor, Grayscale, and buy chunks of the fund at net asset value. They would sell it to you at its fair price, quote unquote. And then they subject you to a 6-month lockup. You could buy at NAV, hedge Bitcoin in some other way, short futures or short spot somewhere else, and then just kind of clip this premium, which as we know was a positive expected value trade. So that happened for a really long time until last month for the first time with GBTC. It's appearing to trade negatively. So that trade seems to be, if not dead, on its way out. And I was glad to see this, honestly, because I felt a little bit vindicated, because I've been telling people who have been asking me about GBTC about the danger of the premium, that it's not a sure thing, that it could go away at any time. And trading structures that we are not privy to, that you can't necessarily see in the market, could collapse this premium.
So essentially, hedge funds were buying the assets of GBTC and selling them?
They were buying GBTC from Grayscale directly at NAV. There's a 6-month lockup. They either hedged or didn't hedge, their choice. And then they would sell at a premium 6 months later. For a pretty consistent trade for a long, long time, up until last month. And I think there's several factors. I think one is the launch of another competing product that's a quarter of the price. So a company called Osprey, who I'd never heard of before Josh Brown announced he was on the board. There's another ticker OBTC. It's trading at a premium right now. It's a very, very similar product that has a 0.50% cost instead of GBTC's 2% cost. So that's a big difference there. And then the bevy of news about a million people registering for Bitcoin ETFs. We'll see where that goes. They just pose kind of systemic risk to Grayscale's product being the most useful product on the market for Bitcoin.
It's so expensive though. The annual expenses of the fund. What is it?
2%.
3%? 2%. That's a lot.
It's massive. Yeah.
Somebody's making a lot of money.
Yes, his name is Barry Silbert, and he's the CEO of Grayscale and digital asset company.
I think that the main reason why you buy that instead of buying Bitcoins itself is because you can potentially put it in a Schwab account or an E-Trade, like whatever your brokerage account. And with Bitcoin, it's kind of difficult to put it in the Schwab account right now. Now, if you have a Robinhood account, you buy Bitcoin, right? So I think it's at some point that fund really has a life expectancy of a couple of years or maybe months before the competition is going to annihilate it. Right? It's being outcompeted in the securities form by more funds, and then it's being outcompeted in technology of brokers to facilitate Bitcoin trading. What would you do if a client comes to you and says, "Hey, I want to actually have 5% of, I'm not going to say Bitcoin, but any sort of cryptocurrency in my portfolio." What's your advice? What would your general advice be in general?
I advise people to be as safe as they can. First of all, to use a model. So if you're going to tell me 5%, I'm going to hold you to that, and we're going to rebalance. And you're going to sell some if you're going to buy some if it goes down, sell some if it goes up. So have a model, a plan for volatility, which is not only expected but almost guaranteed in the Bitcoin space. Getting access to it, there's a lot of ways to do it. A lot of exchanges that are working pretty well. Keep very good records for tax purposes. Do some research on well-known and well-funded exchanges, and then do your best to keep it safe afterwards. So use hardware wallets or multi-signature, especially if we're talking about big dollar amounts. These exchanges have a long history of getting hacked very badly.
I don't have any more subjects, but I think we should probably talk about one more thing, which is the infrastructure bill.
Haven't even looked at it. I heard there's another, 3 trillion? Do I have that number right?
Yeah, but it's over 10 years, so it's a little bit less. But still, like it's insane how much money is getting thrown at the economy right now. I've never witnessed it. Well, at least like we're not in a war, right? Dumping money on a war. So that's a good part. I think it's 2 trillion, what they said, and it's just once you get to those numbers, like 50 billion here, 50 billion there, it's like an Oprah show. Like for you.
Every state, look under your seat.
I think obviously, we have decaying infrastructure. I'm not sure. I will say one thing though: in emerging markets where the money is very much lacking from the government perspective, there's a lot of public-private partnerships. Where the public government will determine the project, and they will build it in conjunction with a private participant in exchange for a concession of 30 to 50 years, right? In the life of a government or in the life of the state of a country, 50 or 30 years is very little, right? So things that could have been built in the 80s at this point would have been under public control again. It's a good way to take advantage of such low yields, because what happens when yields are pretty low is that there is an interest if these projects that are very long term in nature can provide a higher yield for their investment, a lot of institutions will likely commit to putting money down, and it's a good way for regular Americans to invest in U.S. infrastructure. I know it's very political, right? But I think it's a good way to encourage investment in the U.S. infrastructure. There's also areas where you can't really. It's hard to get the money back. For example, I think the U.S. needs to have a national broadband plan. I think there are grants for broadbands in rural areas, but I think they really need to focus on making it affordable for everybody. The problem is you run into oligopolies, right? Comcast, Verizon, these are for-profit machineries that will oppose any sort of plan of getting rid of their quasi-monopolies.
Not to mention they're so big that they're almost too big to fail institutions, where the debt that AT&T carries is bigger than 90% of sovereign nations. It's so enormous, and God knows how much pension fund money is tied up in their various debts that we cannot afford to not have them work well. On that kind of front, I want to ask you a question that I have no idea the answer to, but I want to hear your opinion on. So at the beginning of the show, we talked about China a little bit, and you actually mentioned Africa as future plays of investment, talking about expanding, I don't know, kind of how the world looks for frontier and emerging markets for cheaper labor, right? It's kind of just a function of capitalism. China has famously made a lot of investments in Africa, building ports, building infrastructure, lending money to various African governments. What's your gut reaction to that as a strategy compared to this infrastructure bill that we've just seen, which is very domestic focused in the U.S.?
I think there are two different animals, right? One is, I think China right now needs new markets. They're an export country, essentially, and they need new markets for their products. And the next untapped market is Africa. And essentially, from a strategic point of view, they need to get their products out, and they're constrained by the sea right now. And the sea is actually, if you, from a Chinese perspective, you're surrounded by, democracies, right? You're surrounded by Korea, Japan, Philippines is, you can call it a democracy.
India.
Now, I don't know.
Yeah.
India, the largest democracy in the world. And it's not a good situation to be in when your entire exit for, products could be potentially blocked, and it would threaten your ability to survive. So they need to build other routes. There's a company in, I don't want to mention it right now on the show, but there's a company that actually produces a lot of the garments and shoes. They produce a ton of things for Nike and a lot of American companies, Costco. And essentially they have, 70, 80 factories across Asia. And the moment that factory just becomes unproductive, they just tear it up, move the entire factory over to another country. They move all the assets, just hire new labor. Because eventually what they need to do is just, for them to compete against the market, they have to have the cheapest labor out there. And so it just goes to wherever the labor is cheaper, and there's enough infrastructure to support that. So if you're, you can't compete against these market forces. You can't block off these market forces. So it makes sense to build up the ports and own kind of that infrastructure that's going to provide your companies with the ability to make the market, right? And I think that's what China is doing. It is essentially what America did in the 1900s, while building the Panama Canal and all this other type of infrastructure. It's what the English did, when they built their empire. They created all these train lines to move product around. It's just a continuation of I think the mercantilistic.
Mm-hmm. The Dutch, the Portuguese, yeah.
Yeah. It's just right now it's China's turn to dominate the seas, the world, the manufacturing. They have global ambitions, and the U.S. has just become, I guess, one of the many powers out there.